Hey, what's up y'all? Welcome back to the channel. I hope everyone's been staying safe and taking healthy time for themselves. For those that have been investing since the big market drop last month, there's a chance you're sitting on some good profit right now, especially if you invested in quality companies. Now most of you are wondering, will the market stabilize or crash again? It's a big topic I've been wanting to talk about for a while, so I'm going to share my opinion on the stock market and how it's changing. If you're new to the channel, welcome, and I encourage you to subscribe and hit the bell notification for alerts on future videos I post. If you've been with the channel for a while, thank you so much, and feel free to continue watching and keep hitting that like button to help my channel grow. Now there have been many company layoffs, trillions in stimulus dollars being added, and some parts of the country even leading towards slowly reopening. There's not necessarily a cure or evidence of COVID cases stabilizing yet. The market seems to be pricing in upcoming recovery for many companies. Big investors all have their own opinions and lots of headlines predicting different outcomes of the market. Before I go into my perspective, I want to take you back to the last financial crisis that happened in the US during the time of 2007 and 2008. This was a whole different mess of its own, with unregulated mortgages given to just anyone, underestimation of housing prices being vulnerable to risk, and really bad mortgage-backed securities being sold to investors. If you don't know what I'm talking about, watch the clip in the description below from The Big Short. It's a really good movie aside being educational as well. What many people overlook is that the following year, in 2009, the Federal Reserve had actually done something very similar with how it's influencing the market this year. On a smaller scale back then, the supply of new money added into the system was a result of the stimulus package that propped the economy after most banks had failed and defaulted. Many don't even know this today, but the blue stripes printed on newer $100 bills was actually a reasoning for this, physically identifying new cash that was added into circulation. Now when it comes to 2020, we're seeing a bit of a repeat in history, except this time the economic problem was caused by a virus. With vaccine research and development in progress, there's optimistic hope for a return to normal unlike 2008. New money is entering the system now, making cash even more accessible than it was before. As an investor, the biggest question now is whether the new cash will preserve value, or will we witness devaluation in the coming years once the economic impact is realized with time. After the first QE in 2009, we saw the creation of new businesses and startups. People started making full-time careers from YouTube and social media influencing. Even rappers were joining a higher threshold of wealth. Basically, people were becoming millionaires within a decade, something that wasn't even imagined as possible before. But that's exactly what logically happens when more cash is in circulation. The trillion-dollar pie becomes even bigger, and more opportunities come in the digital era if the economic conditions match it. Right now, the money printing is trying to prop up the money velocity by filling in a giant hole where the economic activity was existing before the country went on lockdown and forced so many people to stay home. What the Fed is doing right now is to try and avoid deflation and not cause inflation at the same time. They wouldn't take any action without proper reasoning. If we were at the same level of economic activity before the pandemic arrived, I'd 100% agree that trillions being printed does not make any sense. But we're at a giant pause when it comes to business activity. The trickiest part now is to gauge whether the Fed will print enough money to fill in the missing gap, not underdoing it or overdoing it, but just enough so that a second big recession can actually be avoided in the coming years, something they were too late to prevent in the last market crash. There's a reason why Warren Buffett is sitting on record cash right now, approximately $137 billion. Even having cash itself right now is a winning strategy, until we know where exactly the economy is heading with certainty. So will the stock market crash again? Yes and no. Yes to the fact that we will continue seeing corrections like we've seen in the past, now especially with certain industries that won't do well in the coming years. No to the whole system failing, with millions of 401ks and stock options being wiped out. It's just not economically feasible, especially with stock trading now being algorithm driven and the Federal Reserve backing the entire system. I believe industry stagnation is the game of this recession, meaning you have to intelligently invest in the sectors that will capitalize on the next decade. Some sectors are booming, some are suffering. There's been a major disconnect between sections of the economy, and I don't feel like the effects in one section are having as much of an effect on others. That's why you shouldn't be jumping in right now to buy any stock just because it's cheap. Airlines, hotels, and cruise businesses, they seem like good deals, and they look undervalued. But based on the charts, there's no guarantee they'll be operating at full capacity like they were trading at before. Will they maintain the same margins and costs while having to pay off government loans too? The main reason money is pouring into the market right now is because no one can earn passively anywhere else. Think about it. Interest rates are horribly low with their normal savings accounts. Property values are in a state of risk with uncertainty around rent payments and mortgage defaults. The market is the only place right now to get a decent yield for the short and long term as well, depending on your strategy. So why are certain companies' stock prices holding up while others aren't? I believe there's 3 fundamental reasons. Option A, the company has a lot of cash on hand, whether it be from past or current sales. Microsoft, Google, and Berkshire Hathaway all fall in this category because of their long-standing profitability. While I don't agree with their stocks being the fastest way to grow your money because of how inflated their prices already are, they are some of the safest companies to have your money in. The ecosystem right now favors companies that are invested in products used every day. Conglomerates like Google and Berkshire all have some of the best balance sheets, with assets far outweighing their debt. Strong companies like Microsoft are still paying dividends too, so you'd still be getting guaranteed quarterly returns, even if the stock market itself trades sideways for a while. Option B, the company is taking on new loans or accessing more capital, whether it's public or private. The main priority for any company right now is to stay afloat with cash on hand. For example, let's say a company is normally burning $350 million a quarter for regular operations. Now in the unique situation we're in, let's say after cost savings and even furloughing their workers, the company is still burning around $250 million for minimal operations, rent payment, and maintenance. A loan of $1 billion will still buy them time for 4 more quarters of survival, without the company needing to manufacture or even make sales during this time. Of course, accessing public or private capital is more desirable, but only certain companies can pull this off, with strong brand value and support. Apple, Starbucks, and Tesla all fall in this category, for example. It was announced in the news that Apple would borrow $8.5 billion with a 4-part bond deal within the US and Japanese bond markets, while already having $190 billion in cash on hand. Starbucks raised $3 billion through US bond markets to continue funding their Asia expansion of new stores and facilities. Even Tesla had announced $2 billion through a secondary stock offering back in February. But recently they've announced that they'll be borrowing through a loan as well, provided by the Industrial Commercial Bank of China, raising $565 million to support production for the Shanghai factory. Out of the 3 companies, I'm personally invested the most in Tesla, since I believe they have the greatest growth potential coming out of this entire environment. Option C, the company is cost-cutting, laying off unprofitable segments and refocusing their business. Layoffs are harsh, and my heart really goes out to folks that are looking for jobs in this challenging environment. Sadly, it's inevitable that younger companies, especially ones that recently IPO'd, will be the first to start downsizing. They just don't have the proper infrastructure in place yet, like older companies do. Tech companies like Uber, Lyft, and Airbnb are among the first major companies to cut a significant percentage of their employees. Uber and Lyft stock prices have risen since then, a surprise to some investors. But fact is, the market is pricing their decision positively, because it suggests better survival for them compared to their previous state. Uber hyper-focused on their food delivery business this time, to make up for lost revenue from ride shares. This quarter, they brought in a record $527 million from Uber Eats, compared to $239 million the year before. Even Lyft is starting a new meal and grocery delivery business to realign their focus in current conditions. These are just a few examples of how a company has to shift itself and make the difficult decisions to adapt and survive for the time being. Airbnb was hit the hardest because of weakness in the vacation and home rental market. This further delayed their plan to IPO soon. Cash, demand, and future longevity. Many companies are failing this test, and their stock price is paying for it. These 3 factors matter the most for the time being, and how the market will price certain companies. Many will argue that the economy and stock market correlation doesn't make sense, but I want to remind you that they're not the same entity. The economy is the current state we as consumers live in, whereas the stock market is based on a future state where our cash lives in. Sure, corrections come, instantaneously or even with delay, but intelligent and patient investing is always going to win in the long term. The American economy has done so well because of the increasing diversity and open-mindedness to new ideas that we've had, and I don't think it's going to end anytime soon. Keep learning, stay patient, and make a plan. I hope you enjoyed this video, and I'll see you next time.